Drop it.
Welcome back. The passive income investors I like to accompany that actually hurts. I tried. Bankrupt Hertz files to sell shares that could be worthless. Ladies and gentlemen, we're going to deep dive down into this company, look at their balance sheet, most recent presentation, and of course, I'm going to share my humble opinion. So consider slapping that like, and let's kick it off with this article that says potential investors in Hertz Global Inc.'s share offering can't say they haven't been warned. In fact, the word worthless appears 5 times in Hertz Monday filings to sell up 500 million shares worth of the car rental company's stock. The U.S. Securities and Exchange Commission's filing, studded with other dire warnings, was also notable for what it didn't have. Investors were surprised last week when Hertz asked a bankruptcy court to issue stock, and perhaps more surprised when the court late Friday agreed to the deal to go forward. Ladies and gentlemen, if you've never heard of the Hertz company before, this is obviously a car rental company, and I just have to state this because when was the last time you ever rented a vehicle when you went to an airport? Because it's primarily where these places are located, and I always use Uber or Lyft. It's just, who rents cars anymore? Who wants to own a car anymore? Let's be real. Nonetheless, the stock is down 87.55% year to date. This company was going into bankruptcy, which we're going to see as we get into their deeper balance sheet, but it's kind of impressive to think this company, leading up to 2019 had record revenues at $9.7 billion. Obviously, they were having problems being profitable, and this is one of those companies I could relate to when I was talking about Pepsi, because Hertz is more of a franchised-based company. I'm going to explain to you what I mean by that in a sec, but take a look at their website. Very beautifully done. I mean, this deserved to be a billion-dollar company at the entire setup. It's clean, it's crisp. You can go through, take a look at their luxury vehicles, their regular sedans, and I mean, a lot of people, you could say what you hate about it, what you love about it, but at the end of the day, it was a pretty solid business up till this pandemic hit. But nonetheless, guys, why is this a franchise company? Well, these are the kind of companies that don't have a lot of underlying assets. They played it off into franchises to try and build cash flow, kind of putting the heavy lifting onto the people that want to get into the business while they kind of take a royalty fee. That's usually how these businesses go, which we'll see if we actually take a look at their assets versus liabilities. I'm looking on my Scotia iTrade here, and if we go to those total assets, we can see this is probably a little backdated, about 2019. So it's still backdated by a year here. But taking a look, they had a total of $24.6 billion in underlying assets, minusing the liabilities of $22 billion. I mean, it leaves them with about, $2 billion. That's not bad. It's not terrible. But at the end of the day, I think that's more related to cash on the books. Nonetheless, it's not going to save them from the pain that they are about to experience. Let's get into this balance sheet, ladies and gents. So what we're looking at right here is essentially the U.S. car rental sales against the international sales. And taking a look in 2020 against 2019, we can see that the revenues have dropped by roughly 190 million. Doesn't sound that bad on the U.S. side of things. And then we take a look at the international. We can see that's where their sales have lacklustered the most. And also they don't have a lot of international, franchisees apparently, because we can see it only does about 400 million in sales in 2019, going into 2020, dropping to 368 million, meaning this company is on a wicked decline. And this is not like a restaurant. This is not something I think is going to come back just as fast. But nonetheless, if we continue to scroll down so we can find out their actual financials here in the millions with the total revenue, so long as this should be the accurate data here, I do believe. We can see they've done $1.9 billion in total here against 2019 where they did 2.1. So we are seeing about a decline of just under $200 million in total. And if we take a look moving forward here, guys, we can see the cash and cash equivalents make up for about $1 billion. So that's where we can see that most of their underlying assets have been, which is what I keep telling you with franchise companies. Most of their underlying assets are based in cash. So we can see their key metrics here, and this is just a company with nobody traveling, nobody likely to travel. You could look at their first quarter earnings and be like, yeah, well, that wasn't that bad. But you got to remember, January and February, the economy was still opening and functioning, guys. This is actually the first quarter we're going into where the full effect of the stress with the shutdowns and everything will start pulling apart these companies and unveiling these terrible balance sheets of companies we know aren't going to survive. And even though Hertz is getting like a bankruptcy trying to pull them out because, yeah, they got a lot of employees, it could be still a sustainable company for the time being. But in the long run, like I said, guys, there'll be a lot less travel. Most people use Uber anyways. And who the heck wants to rent a car after this? So at the end, not related to the pandemic, but if you're somebody that rented a car, let me know in that comment section below. I'd love to hear about your experience, especially if you use something like Hertz. But let's let's just take a look at the recent presentation where, I would love to hear from the CEO. What I should do is I should try and pick up a conference call on this coming quarter, because God knows it is going to be a nightmare compared to the one that we just looked at. But nonetheless, we can take a look going in. We can see for this first quarter, guys, that their March is looking about a 34% revenue growth to the downside. I mean, that's not to the upside. And they don't mention a whole lot in here. There is just no way a company like this is going to be publicizing to any major degree, like the fact that they might not be functioning in the future. And if you have to rent a car down the road, there might be a chance that car won't even be there. And that's a reality that they're facing right now. And we can see that they have the new gold standard. And I'm sure if you go on REITs or any real business, the only thing they talk about is, they're cleaning and just keeping everything up to date, like Carnival Cruise, right? They all talk about this is going to be good. We're going to make sure no one's going to get sick. And at the end of the day, a car, you can sanitize it. I don't think it really matters on the rental end. So I don't know why you're trying to use this as an upsell to gold service to make it look like, oh, I want my premium cleaning service. In fact, all your cars, I think, should be clean. In my opinion, not the best way to be promoting more car rentals. But nonetheless, guys, it's going to be really neat to see if this company can pull it off. It's going to be one that's going to be on my watch list. It kind of reminds me of GameStop, one that I reviewed in the past that somehow is still floating around. But that's a company that I truly believe isn't going to be floating as much into the future, even though I have some exposure to them through the REITs that I own. And at the end of the day, guys, I'd love to know what you think in that comment section below. Quick video, second video today. Hope you enjoyed it. Stay cool, stay awesome, and I look forward to catching you tomorrow.